Welcome to Cycles TV. This session of the Market Cycles Report is intended exclusively to provide information and education to help individuals better understand cycles and the markets. However, this information is not to be construed as professional advice as to the buying and selling of securities. In no event does the host express any opinion with respect to, or make recommendations regarding, the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading. Buying or selling decisions are solely within the personal discretion of each individual. And now, enjoy the show. Here is your host.
Short-term cycles, where are you? 1, 2, 3, I'm coming. Hey, short-term cycles, I'm coming. Where are you? Okay, just for the fun. Short-term cycles. What's up in the markets? Where are you? I really need to close it here. 1, 2, 3, I'm coming. Okay, I have an echo here. Just sorry for that. Yeah, what's up to the markets? What's up to the markets? Friday up. There we have some news out. Markets go crazy. X% in one direction, Y% in the other direction. Is this caused by cycles? Is this just noise? What's happening here? So today I have a special topic we need to talk about. We need to talk about the signal to noise ratio. Of course, and I think that rhymes. When the noise ratio becomes too high, cycles are hard to identify. Let's sing it. When the noise level becomes too high, cycles are hard to identify. But, okay, just kidding. Please excuse, let's have some fun here. That's very important. Today I will not analyze cycles in the current markets because there's nothing to add. Just move back to the last 2 to 3 weeks. It's all still valid. And I know Friday happened this and that, and you're curious, okay, what do the cycles tell us? We need to understand an important fact about the difference of signal and of noise. And the current extreme market movements are more or less caused by noise. Just open the news today. Hey, the Fed warns. Calm down. The market rally could make things even worse from our Fed colleagues, or formerly known as influencers in the world. There's the Fed colleague Waller getting out today in the news and tells us, calm down, take a break. This market rally is not what we want to see. Hey, markets go down today. Whoops. What's happening there? Is this based on cycles? Can cycles even help us to explain these short-term moves? What is the difference between cyclic behavior and noise? And this is an important knowledge to have in mind when we are now discussing analyzing cycles with our cycle analyzer. And therefore, I think today is a very good point in time, even though not analyzing the active markets, but based on the behavior of the active markets. Let's rethink for this session, what is noise, what is a signal, and what does digital signal processing, what we apply to the data series here, is doing, and what it can't do, or where the limits of a digital signal processing are. Because when you look at the cycle detection we have on our screen, we always think, this is a cycle, this is a cycle. But one of the most important secrets, yes, secrets of cycle analysis is not just detecting cycles, but don't tell it anyone else, is having the knowledge when not to use a detected cycle for projection. That's key. That's key. That's key. This is why the difference between signal and noise is so important. Okay, but I will stop the introduction here, and please excuse, but I also want to have fun here with you today. It's live. The chat section is open. Feel free to drop in your comments and questions. Today, I will move over to what I call workbook. It's interactive, so you can use it also on your own after the session. It helps us a little bit learning on cycle analysis. I think the link is already in the chat, so open it there, but at least it will be more important. Maybe first, just follow me here. We will start with some basic understanding, and then I will roll forward to explain the current behavior, which is important to understand. What we see here right now is a simple cycle, in the center, and at the bottom we see some noise. I will even make it larger because that's the first point we need to understand when analyzing cycles. And to explain the picture a little bit better here, so we can now activate and deactivate certain components here. Let's assume the gray line here in the center of the screen is today. So to the left-hand side, we have the past. And to the right-hand side, which is here the dotted line, is our projection area into the future. And on the bottom, we see current detected cycle, for example, based on our cycle analyzer here. And at the bottom, I have now added the so-called noise. And the first thing is we need to understand the difference between the signal, and the signal is here the cycle. The cycle is our key signal we want to detect, we want to identify, we want to measure, and we want to project. But as always, for sure, the data is not as clean as the cycle looks like. So therefore, at the bottom, we need to take into account that there is some noise in this data. And to measure the signal-to-noise ratio, and it's just basic understanding. You never need to do this on your own, but to understand the principle, I need to visualize it now first. You measure, so the distance from here, from the top to the low. This is what we call the signal, or the strength of the signal. In simple terms, that's also the amplitude, which is given by our cycle analyzer. And the range from here to here, so this distance, is the noise. And noise in the stock markets, is, for example, news, just a one-time event. A CPI figure is coming out, and hey, there's a one-time activity in one direction or the other. So from a digital signal processing perspective, this is just noise. News or movements related to one-time news is nothing more than noise, which is not the real signal we want to detect. So the key is to differentiate or to identify the signal out of noisy data. And this is possible when the signal ratio, or the signal to noise ratio, is very high. So we have a higher signal amplitude than the noise amplitude. When the noise level gets much higher, so we increase the level of noise in the signal and keep the signal line, then the noise ratio gets higher and higher, and the signal gets invisible in the data set, and this will make a digital signal processing routine, whatever you use, more or less impossible to detect the real signal. Or it will tell you there are 10 cycles in this data set, but it's just pure noise, and the routine is not able to detect the real signal right now. And let's now move forward with some more complex examples here. So that's the difference between the signal and the noise. And in the markets, always both is available at the same time. So I will now turn on the noise in our data set. So, and the black line is now the combination, of the noise or signal plus noise is the black data set, what you see here above. So signal, plus noise is equal to the black data set, what we see here. And we observe only the black data here, and we need to then put it into two data sets, a noise data set and a signal data set. So that's, and in the situation where the noise ratio is as low as, for example, as shown here, and you can see it even visually, there's no problem to identify the cycle here, even though we have noise in this data set. So that's always what we assume here. And for this long-term cycle, even the short noise in this data set will not really make a difference. But let's assume, and that's often what I try to tell you or explain, it, there's never just only one cycle active here. So we can now add a second cycle here to this data set. And let's start with these individual cycles here. So here in the center now you see different cycles which always are present at somehow or the other, and this is what our digital signal processing tell us. And I will now build a composite out of the blue one and the green one. So these first two cycles here. So I will then activate the composite of cycle 1 and cycle 2. And you see, this is then the composite cycle plot here, which results in this behavior. And now the noise is again overlaid. And with this noise level, we are still able to, at least the longer term cycle is still no problem here to detect. Yeah, so we see the long term cycle. It's no problem for us or even a digital signal processing to identify in this data set. Even with this noise ratio here, it would still be able to see these shorter term cycle ups and downs here in this data set. This would be okay, yeah? You see how it follows this line here. That's okay. But now, let's increase the amount of noise in this data set here. So I will now increase the noise ratio. You see now the orange line here down below is now larger. And what you see at this noise level, that again, the larger term cycle, here's no problem to identify. But what is now quite masked by this, by these noise here down below, and you see now the noise level is much more higher here. The shorter term cycle, which is still in the composite, so we have this short term cycle here. I'll just show it here, which in the composite model is no problem to detect. But this short-term cycle is no longer visible, and even it will not be able for digital signal processing to short-term cycles in this data set. And that's the important point here. It's not that you can't detect cycles when the noise level becomes much more higher, as shown here. The longer-term cycles are still valid, still visible, and will be detected by a digital signal processing algorithm. But the shorter term cycles, and that's the point here, the shorter term cycles get masked or wrapped into a noise floor which is too high then being able to really identify here the short-term movements, yeah, here and here. If you just zoom into this area here, you won't be able to detect any cycle here. Same here at the lower range. It's just because of the noise level, and you can now play this game with even complexer signals. And you see now when I lower the noise level, yeah, which is more the standard data, you will see that the cycle is, even the smaller cycle is now more being able to be seen. And to make it even more complex here, you know that we also have some trend in this data set. So let's also add some trend here. And this will make it then even more complex at some point in time. So when I now start to increase the noise level, also with this trend, yeah, you will see it's more or less impossible to see any real short-term cycles in this kind of data set here. Yeah, even here. The data is built on cycles. So what you see here is built up on cycles, but you see this noise level is just too high. And this happens, and that's really why during these times when you see one-day moves of 7%, I think in the Nasdaq or the broader market, 5% movement on one day, and you want to find a cycle which can explain this movement, I think that would be exactly the wrong approach. And therefore today I do not want to switch to our cycle analyzer to take into account, for example, the movements of last week. Yeah, so the high push we saw on Friday, because it just increased the noise level. We don't want to measure noise, or even now our cycle analyzer digital signal processing tries to fit this as a signal, while we could assume this is just driven by news. We know that this move was just driven by the CPI figures, which came out in the hope of the Fed and the crazy crowd out there, which is currently only driven by very short memories, very short signaling. Oh, the December rate hike might not be as high as maybe it will be. So the risk on bulls have gone into the market, and the other ones which have been short have been squeezed out on that day. But is this now the start of a bull market? Has really something changed fundamentally with the news out there? No, nothing changed. No real fundamental change which could be accounted to cyclic behavior. It's just one news figure. And even though the Fed goes out today and warns you, stay calm, be careful, the Fed has explained us today, was just noise what happened on Friday on the stock markets. Therefore, before too quickly jumping now back to our cycle analyzer, open up the daily chart, trying, has a cycle changed? No, cycles have not changed. Don't get fooled. At least the cycle signal has not changed. For short, if you are able to trade noise, welcome, but that's not the place to trade or project noise. Read the daily news channels and try to be the first to trade the news. That's noise. That's maybe profiting from this 7% move, but nothing to do with cycles. Therefore, I mean, you maybe want me now to look at the cycles chart, but I will not do. Because it's just noise out there. And that's the topic I want you to really take forward and put into your thinking when in the future you look at the cycles chart. You need to understand the data set. You feed into it. And you need to have a feeling about what's the noise floor. I mean, there are always one-time movements. There's always noise. That's the purpose of any real data set. But get a clue about how much noise is moving maybe your data set. That's, for example, one reason why I avoid Tesla. I avoid analyzing the Tesla stock for cyclic movements because Tesla, the noise ratio in the Tesla stock is so high that even though there might be cycles, you won't identify them using Tesla. Because when Musk is doing whatever he thinks to Twitter, or smoke the next joint, or buy Twitter, or whatever he wants to do, then there might be a large jump in the Tesla stock prices, which is just news-driven, one-time event, noise. So therefore, don't apply cycle analysis to this kind of data set. This is what happened Friday to the broader market. Noise. Our cycle analysis routines will not help us here. And therefore, that's the point for today. And please forgive me if I'm just arguing about this one single point, but it's so important as a cycle analyst to have basic rough understanding. In technical terms, it's called signal-to-noise ratio. Applying this to the stock market, news-driven, one-time-driven movements is noise. Noise, in technical engineering terms. If this noise amplitude is too high, don't apply it with the cycle analysis routine. So therefore, you need additional measures. For example, technical analysis. Technical analysis will help to find extremes in this noisy environment. Therefore, I showed you this springboard delta is just an example to also differentiate the noise between bonds and stocks when there's the difference or the noise, the one-time events drive the one or the other into one or the other extreme. And if this happens regularly, then you have an additional cycle. So that's always find ways to get a clue on noise in your data set, get a feeling about that. And if the noise level is low, that's the purpose of this playbook. And I hope use the link a little bit on your own to play with it. Just to explain, you can even activate more cycles. You can activate up to 4 cycles in this data set, like I showed you in the in this data set here. So you can even make it more complex, and you see here how the overall composite changes. Just so let's build a complex data set just on one cycle, at a second cycle, shorter term cycle, at another one and another one. This is pure trend and 4 different cycles with the lengths you see here down below. And now increase the noise floor. You will see that the short-term cycles will get impossible to measure here in this data set. And I think that's a good example. And I like these kind of playbooks because they help you to play around with the cycles. If you scroll down, and you can change the wavelength here from the longer-term cycle. So it's really interactive.